Hi everyone, welcome back to another week on Technical Insights. Last week, we had some key macroeconomic data from the US, as well as some comments from the ECB president and the US Fed chairman on inflation and the rate cut outlook. On Thursday, Fed Chair Jerome Powell said that the US Central Bank was not far from gaining the confidence that inflation is falling sufficiently to begin cutting interest rates. From the European Central Bank, they kept borrowing costs at a record high of 4% last week, and the ECB president hinted strongly that more was likely to happen at the ECB's 6 June meeting, as which data for the first quarter will then have been published. Before we dive deeper, let's do a very quick recap on how the market has ended last Friday. Our Singapore Straits Times Index was up 13 points or 0.42% on Friday. In the Asia region, market mostly ended in the green. Japan Nikkei 225 added 0.23% on Friday, but posted its first weekly drop in 6 weeks on profit taking. The Nikkei 225 index crossed the 40,000 level for the first time ever last Monday, when the benchmark soared past its 1989 record high. Shanghai Composite Index gained 0.61% and Hong Kong Hangseng Index advanced 0.76% amid the expectation of global central bank will ease the monetary conditions later this year. On the US side, stocks retreated on Friday. The Dow Jones Index lost 68 points or 0.18%. The S&P 500 fell 33 points or 0.65%. The Nasdaq Composite Index was the worst performer last Friday, sliding 188 points or 1.16% after rising to a new all-time high earlier in the intraday session. Much of the pullback came from Nvidia, the AI darling, which finished down more than 5.5% in its worst session since May last year. Despite that, Nvidia shares were still up more than 6.3% last week, part of a monster rally that has added more than 1 trillion to the stock market cap in this year alone. But this does not mean that the long-term upside potential is over for Nvidia. It's just that the market or investors has gotten ahead of themselves, and now we have headed into an overbought situation, so it's time to take some profit off the table for Nvidia rally. Before we go into the weekly recap, let's look at some of the key economic data from US. The February non-farm payroll data was released last Friday. It offered some conflicting signal as to when it will be safe for the US Fed to start cutting interest rates. On one hand, the number of jobs added last month was much more than expected, coming in at 275,000 as compared to the estimate of 198,000. This data implied that the economy is still running pretty strong. With the strong job growth number, unemployment rate unexpectedly ticked higher, coming in at 3.9% against the consensus of 3.7%. Average hourly earning also came in slower than feared at 0.1% against the consensus of 0.2%. Data for January job growth was also revised lower to 229,000. In summary, I think the Friday's job data illustrate that the Fed is actually achieving its dual mandate of having high unemployment while keeping inflation tame, and kind of solidifies what Jerome Powell was saying last week about the confidence he had in the potential to begin the rate cut cycle later this year. Back to the weekly view on the markets. All three major US indices finished the choppy week lower. The blue chip Dow Jones Index fell 0.93% to end the week at 38,722 points. The decline marked the worst week for the 30 stocks down since October 2023. Broad index S&P 500 pulled back 0.26% to end the week at 5,123 points. The Nasdaq Composite Index collapsed 1.17% and was the worst performer among the three US indices, settling at 16,085 points on Friday. In Asia, the Hang Seng Index continued their slides from the previous week, down 1.42% for their second consecutive week, settling in at 16,353 points. The Hang Seng Tech Index followed the HSI down 2.94% to 3,385 points, losing much of the 2.6% gain that they saw last week. For the week, our STI index was up 11 points or 0.36% to settle at 3,147 points. We broke a 2-week consecutive losing streak, with much of this week gain coming in on Wednesday and Friday. Two of the biggest winners on the STI index last Friday was DFI Retail Group and Hong Kong Land. Their shares jumped 5.4% and 2.8% respectively. So for this quick technical analysis, let's look at both of these big winners on our benchmark index. First, let's look at DFI Retail Group. The company announced their results for the fiscal year ended 31st December 2023 last Thursday after market. the group posted a 437% increase in underlying earnings to $155 million from the earnings of $28.8 million in FY 2022. Their share price jumped 5.42% last Friday, or 11 US cents, to close at $2.14. So will the rally that we see last Friday continue? Let's look at the chart of DFI. Their share price hit a high of $3.33 on 6th of February last year. After hitting that high, the price has been on a downtrend, forming a series of lower lows and lower highs. Prices seems to have hit a bottom this year on 31st January when it touched a low of $1.98. The low on 30th October at $2.11 seems to be a support term resistance level for DFI share price, limiting much of this year's range under that level. After the results last week, the share price closed at $2.14, convincingly above the $2.11 level, which is the 30th October low. On the MACD indicator, the MACD line looks set to cross above the signal line in the next few sessions. A cross of the MACD line above the signal line indicates a change in direction upwards. And if both the MACD line and the signal line breach above the zero baseline, the uptrend momentum may accelerate further. Last Friday, the RSI indicator also breached above the 50-point neutral mark to 55 points, an indication again that the uptrend momentum is accelerating. So based on the momentum reading of both indicators, the rise in DFI share price last Friday is likely to continue this week, and the next resistance could be the low on 23rd of August at $2.32, which is another level of a support term resistance level to watch out for, before the price retreats back to its primary downtrend again. Next, let's take a look at Hong Kong Land. The company also reported their results last Thursday. The developer sank into the red for the financial year ended 31st December 2023, posting a full-year loss of $582 million from a $202 million profit the year before. Interestingly, their share price did not suffer a fall despite the financial loss. Looking at the price chart, Hong Kong Land share price hit a high of $4.83 on 30th Jan last year. Prices subsequently moved into a long-term downtrend, bottoming out at 25th October at $3.07. The $3.07 level was tested twice this year on 22nd January as well as 5th of March and have held up pretty well, indicating a very strong support level over here with buyer interest and demand coming in. Prices then rebounded to a high of $3.51 on 2nd of January high this year, but was unable to form a higher high, suggesting that this long-term downtrend is still in play right now. On the MACD indicator, we observe a weakening of the downside momentum in the last two trading sessions. The MACD line could also cross above the signal line this week, and that could confirm a change of direction upwards. The latest RSI reading last Friday was 51, a point above the 50-point neutral mark. This indicates that there's a very weak uptrend momentum reading for now, but should the RSI rise further, that could signal the uptrend is gaining further momentum. The next resistance to watch out for will be the 29th February high over here, which is at the level of $3.38. Above that, we will retest the 2nd January high again at $3.51. And these are the updates that I have for you this week. So do remember to like, share, and subscribe to stay up to date to our latest content. And I'll see you again next week in the next Technical Insights.